Everyone, welcome back to the Weekend Charts. Charlie Bilello here. As always, I'm going to run through the most important charts and themes that we're seeing today, and we have a lot to talk about. Fed earnings, a lot of economic data, so let's jump right in and talk about that Fed meeting. The question, was that the 11th and final step for the Fed? Everyone seems to be asking that, but let's rewind, going back to a day before the meeting. And what do I always do? Well, I do tomorrow's news today. This would become a fan favorite on Twitter. People love to see it. A lot of people seem to disagree with me when I put this out there. Many people agree. I can't predict the future. I don't have a crystal ball. How am I able to predict every single time what the Fed's going to do? Well, simply because the Fed does exactly what the market's expecting it to do in every single meeting since the beginning of 2009. So there was a pretty much 100% probability looking at Fed funds futures in terms of what the Fed was going to do. They were saying the Fed was going to hike 25 basis points. That's exactly what the Fed did. Now they brought that Fed funds rate up to a new range of 5.25 to 5.5%. That's now 525 basis points in increases since the first hike in March 2022. So far above what people were expecting. If you talk about back here, even in the middle of 2022, end of 2022, even early this year, the Fed has done much more than people were expecting. So where does that leave us in terms of the Fed funds rate? Well, it's now the highest Fed funds rate in the US since January 2001. So you have to go back over 20 years to find a higher Fed funds rate than we have today. And in terms of where monetary policy is it tight? Is it easy? Well, now we flipped. We're on the tighter side of things. So if we look at the Fed funds rate and we subtract CPI, we subtract the inflation rate, which is now 3%. Now we have the highest real Fed funds rate in the US since 2007. So 2.4% real Fed funds rate. This is now restrictive monetary policy. We haven't seen this much in terms of tightness from the Fed since 2007. Now, all of the people are talking about what's going to happen going forward. That's the question in terms of asking Powell in the press conference. Everything is about, well, what are you going to do from here? Are you going to keep things? You're going to pause again like you did in June? Are you going to hike again? And what are you going to base that on? And what Powell basically said is he doesn't know yet what he's going to do in September. It's going to depend on the data points between now and then. But if we look at what the market's saying that the Fed's going to do, the market's saying the Fed is essentially done. Now, if we look at Fed funds futures, they're saying the Fed's going to pause throughout the remainder of this year. They have 3 more meetings left. They're going to pause early next year and then start cutting rates in May 2024. Now, if you remember what this was showing a few months ago, you'll understand that you should take these expectations with a grain of salt. A few months ago, the Fed was expected to stop hiking rates in May. So this rate hike was not priced in a few months ago, and the Fed was expected to start cutting rates before the end of this year. So everything has been pushed out, and the Fed has done an additional rate hike from just where expectations were a few months ago. And you can be sure that if we look ahead to a few months from now, these expectations are going to change again. What could change them? Economic data points, the Fed's rhetoric, how they feel about inflation and the data that comes in, all of that's going to impact this. But for now, the market's saying higher for longer, but not any higher than where we are today. So market's essentially saying inflation will likely not reaccelerate to the upside. The Fed's going to be comfortable staying in this restrictive area at least until 2024, May 2024. And then at that point, the market's saying they'll start cutting rates. And that could either be due to economic weakness or due to the fact that inflation has come down to the Fed's desired level, which is around 2%. Now, this is pretty important in terms of the Powell language. I think he's still trying to let people know that they might not be done. And I think core inflation is what the Fed has been focused on. As we'll talk about in a little bit, I think core inflation is likely to come down largely due to that housing data. But if we look at his comments in the press conference, he said core inflation is still pretty elevated and they're going to need to hold rates at restrictive levels for some time. Now, what does some time mean? That could mean a few months. That could mean a year. That could mean 2 years. We don't know what exactly that means, but he did say that they'll be prepared to raise further if they think it's appropriate. So are we done here? Maybe, possibly, if we see CPI, let's say, go back over 4%, start heading towards 5%, will the Fed hike again? I think that's likely. If we stay in a range between 3 and 4%, will the Fed hike again? Less likely. If we go down to under 3% and start heading towards 2%, their target, that becomes less and less likely. So all of this is going to be reflective here. As we approach that September meeting, we have a lot more data in terms of employment, in terms of inflation, and that's going to drive things. And then I think we'll have that same expectation going to that meeting. Will set my expectation in terms of what the Fed's going to do. So as we get closer, we'll monitor that. But for now, the market's saying higher for longer. The market seems to be comfortable with that. We'll talk about that in terms of the equity market. But all of this is subject to change as we get new additional information. Now, big question in terms of the economy is, how much of an impact have these 11 rate hikes had on the average American household in terms of, are these rising interest rates hitting household budgets? Are people having to spend more on interest payments? And I think the expectation going into the rate hiking cycle, especially if you told people back in March 2022, Fed's going to hike 11 times, they're going to go all the way up to 5.25 to 5.5%. People would have said, well, this is going to have a big impact on the American consumer in terms of the economy. They're going to start spending less. It's going to hit budgets. And the reason really it hasn't had as big of an impact as people thought is just looking at the data in terms of how many people have adjustable rate debt versus fixed rate debt. And if we look at the data today, it shows that 11%, only 11% of household debt is adjustable rate. The remainder of that debt is fixed rate debt. So if you think of most people who have mortgage debt, that's a fixed rate mortgage, usually a long-term mortgage. 30-year mortgages in the US are the most common. And that interest rate is not adjusting with the Fed hiking rates. Now, if you have an adjustable rate mortgage, that's a different story. That can adjust after 5 years for most people. That can adjust higher, but very few people have that in comparison to the 30-year mortgage. Now, if you have a car loan and you took that out years ago before the Fed started hiking rates, well, that's fixed rate as well. If you have student loan interest, for most people, that's a fixed interest rate as well. So for most people, as of yet, this hasn't, if you have that fixed rate debt and you're locked into these low interest rates, the Fed's rate hike isn't impacting it. So if we look at, and this is the important chart here, household debt service as a percentage of disposable income, still very low in the first quarter. It's certainly up from where it was in the first quarter of 2021. It's 9.6%. It was as low as 8.3%, but still well below the average that we've seen over the past, let's say, 40 years of 11%. So this can certainly move higher, but still remains very low. It doesn't seem like most households are stressed yet from this rise in interest rates. Now, who is this debt hurting? Well, anyone with adjustable rate debt, and typically that includes credit cards. So a lot of people don't pay off the balance on their credit card every month, and those interest rates likely have been rising. How do we know that? We got new data out of the credit card world. Average rate of a credit card in the US is now up to 20.7%. Where were we in March 2022 before the Fed started hiking interest rates? 14.6%. So this has moved significantly higher. So if you have an outstanding balance on your credit card, you're paying more for your interest. That can become problematic. Best thing, of course, you can do is try to pay that down. It's like earning a 20% return on your money. So first thing anyone should think about before they think about investing is getting rid of credit card debt. And now that's more important than ever with this rate this high. But certainly if a household has a large amount of credit card debt, they're feeling the Fed's rate hikes, and will continue to if the Fed continues to hike interest rates. Who else is this impacting? Well, anybody who's in the market for a big asset purchase today that doesn't have a house, let's say, or have a car, or needs a new car, or even a used car. Most people finance those purchases. Most people don't pay cash for that. And the interest rates, obviously, on used cars, new cars, and loans and housing in terms of mortgages have skyrocketed. So not only have prices gone up in terms of car prices and house prices, but also you have a much higher interest rate. And so it's an interesting data point. If we look at starter homes, this would be a pretty good example here as compared to June 2019. So just a 4-year period, the average price of a starter home in the US is up over 40%. And so that's a significant increase in a very short period of time. Needless to say, people's incomes aren't up anywhere close to that. But this is just half of the equation. This just assumes, let's say, you were paying cash for that starter home. If you had to finance that with 20% down, the monthly mortgage payment you would need today in June 2023, 4 years later, would be more than double in terms of what that monthly payment would be versus 2019 levels. So who is these rising interest rates hurting? Well, people who don't have that assets and aren't locked into the low interest rates, anyone new to the market. And we've talked about how that's impacted the housing market, how it's impacting in terms of the average payment for cars has just skyrocketed. So people who need new debt being impacted, and that's slower to filter into the economy because many people with existing debt are benefiting because they refinanced or took out mortgages at very low rates. So remains to be seen how much these Fed rate hikes will impact the economy and how quickly. It simply may take more time. Not that they're not having any impact, but I think this is the big factor explaining why it hasn't had as big of an impact as people thought. So in terms of the U.S. economy, all of the recession predictions coming into the year have been proven wrong. We got the first read on GDP, real GDP for the U.S. for the second quarter, and it was a good report. It was better than expected, widely better than expected. The year-over-year growth rate, 2.6% in terms of real GDP, so better than we saw last quarter, better than the quarter before that. So kind of a reacceleration of growth here. And if we look at the Atlanta Fed's GDP now estimate, well, they were right on the money, 2.4%. So all of those better than expected economic data points filtering into real GDP. And importantly, the blue chip consensus, which is the Wall Street estimates, were much lower. So I think the average consensus estimate right before the GDP report was around 1.5%. It came in at 2.4% annualized for the quarter. And so much better than expected. Market actually responded pretty well to that. For now, good news seems to be good news. That's been the case all year long with the beats in terms of economic data points. It'll be interesting to see how much longer that continues, and if we continue to see economic data surprise to the upside. But certainly through the first half of the year, no recession in the U.S., and that was a surprise to many economists who predicted a recession entering this year. So let's talk about the stock market here. We had an epic run in the Dow, 13 consecutive positive days for the Dow, positive trading days. That was tied for the second longest winning streak in history, tied with January 1987. Anytime you say 1987, everyone's like, the crash coming. Now, of course, the crash in 1987 didn't happen until October of that year, so there was a huge advance between this January streak and then. But the point of doing these streaks is it's just a fun, interesting data point. I think a lot of people tend to read too much into this type of thing. I've tested the data. I've looked back at these streaks in the past. Does it indicate anything for the market unusually going forward? So does a long streak of up days indicate the market's going to do better, let's say in the next year, the next 2 years going forward? For a long-term investor, no, it's all just noise. There's absolutely no information in these long up streaks to be gleaned. It's just an interesting data point, certainly not actionable. Now, if we look into the Dow and see what has been performing this year, very different story than what we saw in 2022, really the polar opposite. Top 4 companies in the Dow this year, all in the technology sector. You got Salesforce, Apple, Microsoft, and Intel, all up over 40% this year. So really the flip of 2022 in terms of growth, tech, large caps, as we'll talk about in a little bit, all outperforming widely year to date. So what is the market's advance doing to sentiment? We've been covering this the last month here, but it continues to move in this direction. More and more people are getting bullish. Why are they bullish? Well, we're having one of the best starts to the year for the S&P 500 we've seen in history, up now over 19% through the first 143 trading days. So pretty good advance, short period of time, gets people bullish. We also have the fact now that 525 basis points in rate hikes has not led to a decline in the stock market. This S&P 500 is 5% higher than it was in March 2022. So we've taken that big wall of worry in terms of inflation and the Fed fighting inflation off the table for the time being, because the Fed has already thrown 525 basis points at the market, and the market's 5% higher than where it was when it started. And this is not unusual. As we talked about when the Fed first started hiking rates, the previous 3 rate hiking cycles actually saw the S&P 500 higher during the period where the Fed was hiking rates. So let's say this was the last hike. This would be another data point where the S&P 500 cumulatively has gone up during that period. Now, we did have that huge drawdown last year, but all of that has been recovered, and now we have an S&P 500 that's only 4% away from a new all-time high. And in terms of volatility, this gets people, I think, much more bullish. When they see lower volatility, they tend to be more comfortable with the market. There's less bad news going on in terms of the daily news cycle explaining why the market's moving up and down. That gets people much more bullish in terms of not seeing these big swings back and forth. So we have the lowest weekly close for the VIX, the volatility index, since January 2020. So if we look at active managers, we've been covering this the last few weeks, continues to move in this direction. They continue to increase their exposure to the equity market, and now they are levered long, over 100% long on average. If we look at this name, active manager exposure index, and we haven't seen it this high since November 2021. So again here, this doesn't mean the market has to go down. It just means it's not as bullish as it was last October, when these same active managers had less than 20% exposure to the S&P 500, when it was at over 1,000 points lower. So now they're all in, and then some, with the S&P 500 getting closer to its all-time high. So on the inflation front, what are the data points saying that the Fed can pause here and likely pause for the rest of the year if the market is correct? Well, every week we seem to get more of these data points. We got a few more here. I'll run through them quickly. PCE price index down to 3%, below 3%. It's the lowest since March 2021. It peaked last June at 7%. The average over the last 20 years is around 2.2%. So we're getting closer to that average. That's one data point. Then we have used cars continue to come down. The Manheim Index, if we look at July, hit another 52-week low. So we're seeing used car prices trending lower. This is a wholesale index, so we're likely to see this filter into retail prices. We're seeing it already in the next few months. So lower retail prices are likely coming in the used car area. Then we have home prices. Home prices now down 0.5% year over year. Not a huge decline, but still down. Very different than the picture we were seeing. We're over 20% gain here, that huge acceleration in home prices. Well, now we're down slightly on a year-over-year basis. If we look at the 20 city index, it's actually down 2.3%, with many cities down on a year-over-year basis. And even the cities that are up on a year-over-year basis, not huge gains, and not the ones that were kind of leading the advance. So even the hottest areas like Miami, up 3%. Tampa is up less than 1% over the last year. And the other hot areas like Phoenix actually down year over year, Las Vegas down year over year. So we're seeing housing market at least moderate here. Not huge declines, as we talked about many times. The reason for that, big reason, is simply very little supply. So demand has been crushed due to rising mortgage rates and high prices, but supply has been crushed as well. And for now, that's keeping a lid on prices. But in terms of inflation, this is going to have a big impact. And also, the rental part is going to have a big impact as well. We're seeing rents now down on a year-over-year basis as well, down a little less than 1%, but still down year over year. And this rental trend is likely to continue because we're seeing an increase in vacancies. So we now have 7.3% vacancies in the US. That's now above the pandemic high that we saw in 2020 of 7.2%. So more vacancies means less likely that landlords are going to raise their rents. And additionally, we're likely to see more supply coming. If we look at the housing under construction, 5+ units, so multifamily units, it's at a record high. So this is going to take some time, obviously, for these units to be operational. But when they come onto the market, you have more supply. That's going to put a lid on prices as well. So no, most landlords aren't going to be cutting their rents. But if you're looking at new listings, new apartments, you're actually seeing a year-over-year decline on average. So all this has not yet been reflected in the inflation data because, as we talked about, the shelter component is a severely lagging indicator. And if we look at rents here versus that shelter CPI number, rents are now down 70 basis points over the last year, while that shelter CPI, the last reading we got, was still a 7.8% increase. So now I think you're going to start to see this come down more meaningful in the back half of this year as it catches up with the actual rental data, the actual home price data. You're going to start to see this really move down. And that's going to have a big impact on overall CPI because rent is over a third of the overall CPI index. And it's even a bigger part of core CPI. So core inflation that the Fed is worried about, likely to see that come down in the coming months. So again, just another additional data point that the Fed's going to have that suggests that they can stay and pause for a while if they so choose. So be on the lookout in the next CPI report to see if we see a bigger move down in that shelter component, and that's going to have a huge impact. Again, it's going to happen. It's just math. It's going to, with a lag, reflect this data that's showing that apartment prices are going down, rent prices going down, and home prices going down. This is going to continue to go down. Now, if the actual data starts to move up again, well, again, that'll follow that at some point in the future. But for now, we're going to see this trend lower in the coming months. So getting to the equity market, and the big knock on the equity market, if we look back a few months ago, was that it's just a few stocks driving the market higher. It's really just big tech, and everything else is not really performing. Well, that story has really changed here. We've seen these other areas catching up to the NASDAQ 100 growth names. Now, still wide outperformance. QQQ's up over 44% year to date. Growth stocks up 33%, so huge returns there. S&P over 20%. This is all including dividends. But these other areas, if we look at small caps, if we look at emerging market stocks, if we look at value stocks, they've really accelerated over the last 2 months, and the rally has been broadening. So the big knock was there's not enough participation by these other areas. Now we're seeing it. So you're hearing less of that, and that's just another factor, I think, driving sentiment higher. When you see broad participation, when you see a rising tide that's lifting all boats, people tend to be more excited about that. So we'll see if this trend continues. We'll see if we see what we saw, let's say, for some periods last year where we saw this outperformance in value and small caps. We'll see if that continues. Thus far, it's just been a catch up. We'll see perhaps this marks a turning point where these areas start to see some outperformance and we start to see growth, which has had a tremendous run, start to pull back. So the expectations certainly much higher for the big cap tech names than they are for these areas like small caps, emerging markets, and value. So we'll see if there's a sentiment shift once again. So talking about earnings, certainly better than expected. We have S&P earnings per share up 7% year over year, with 46% of companies reported. So we still have a little more than half to go. So these numbers could definitely change. But so far, most companies beating expectations, pretty decent earnings report. If we look at the earnings picture in terms of where we are relative to that peak earnings quarter that was in the fourth quarter of 2021, we're still below it here. We still have GAAP earnings down 15% below that quarterly peak, and operating earnings, I think, about 10% below that fourth quarter of 2021. So we're not quite there yet, but the expectation, if you look at the data from S&P Dow Jones, is saying we're going to hit new highs in earnings in 2024. So what they're essentially saying is market's moving higher here ahead of earnings, which it always does, and it's saying that the earnings are going to come in the back half of the year and next year and push this thing back to new highs. They're looking at a new high for trailing 12-month earnings. If S&P Dow Jones is correct, they're saying we're going to hit a new high in the fourth quarter of this year in terms of trailing 12-month earnings. So big driver of earnings, of course, the big tech companies. They certainly beating estimates here. If we look at Google, hit a new 52-week high after earnings. Big beats on not just revenues, but net income as well. So revenues up 7% year over year, accelerating higher again here. Net income up 15% year over year. So Google, obviously one of the big 5 companies in the S&P 500. That's very important. The second biggest company in the S&P 500, Microsoft, saw an acceleration in its revenue as well, 8.3%. Net income up 20%. So all of the kind of efficiencies and cost cutting that these tech companies did last year, well, you're seeing that play out here. Revenue is up and earnings are up more. So they're getting that operating leverage by that cost cutting that they did in 2022. And we'll see if this trend continues. But so far, pretty much every major company has beaten the consensus estimates. Now, all of these stocks are up huge already year to date. So yeah, the question then becomes, well, what's priced in at this point? But for now, in terms of the actual earnings, you're seeing that reacceleration. I think that has definitely contributed to better sentiment. As we always talk about, stocks lead earnings. So stocks bottomed last October. Earnings were terrible. They continue to be terrible in the fourth quarter of last year. And stocks were moving up early this year before we got the news of better earnings. And so that's just the way markets work. You can't look at earnings. They're a lagging indicator. The markets always move in advance of that. And it's a very difficult game to play, trying to time your exposure to the equity markets based on the earnings data, because you're looking at lagging data when the market is forward looking. So I want to end with something positive here. This is the fact that Americans are going on vacation again. We had a big downturn, not a huge surprise, obviously, in 2020 in terms of the monthly average of U.S. workers taking vacation days. And that was also the case in 2021. In 2022, we saw an increase. But so far this year, first 6 months of this year, we're seeing the highest rate of vacation days that we've seen in over a decade. So this data goes back to 2010, and we have now 2.6 million workers per month taking a vacation. This is the data just on the first half of this year. So certainly good news for the economy, good news for people. People needed a break after this period of time for sure. And we've talked about this, but this is definitely driving the travel industry, driving consumer spending in terms of people are spending less on goods, but much more on experiences. We're seeing record numbers in terms of airfare and hotels. So all of that is getting a boost and certainly a good thing, and certainly well-deserved for people that have been working hard through a number of difficult years. So great thing to see. And we're going to end it right there. That's it for this week. Have a great week, everyone. If you like the content, as always, subscribe to the channel for more content just like this, and I'll see you next time on the Week in Charts.